Hello and welcome to this week's episode of the SME Exchange series with a special focus on mentoring. The underlying objective of the mentoring series is to guide and advise passionate entrepreneurs on how to overcome the hurdles and scale up. Today we have in our studio two passionate entrepreneurs who wish to be guided and mentored. They are Mr. Souvik Naik, Director of the Kolkata-based SN Fabricators, Mr. Vamsi Krishna Kaki, founder of the Delhi-based Jet Set Clean. Guiding these two entrepreneurs are Mr. Kewal Handa, Chairman of Salus Lifecare, Mr. Ajeet Khurana, he is an angel investor, and Mr. Ajay Thakur, Head BSc SME Exchange. Gentlemen, welcome to the show. Souvik, if I may begin by asking if you can tell the mentors here, what is the line of business you do, when did you start it, how many people are employed, and what is the turnover?
Well, we had a very modest start in the year 99. It was initiated by my father, late Mr. Naik, along with my brother Souvik and myself. We were in a big way for the fabrication of structures and equipments for steel plants and refineries. Okay. And in 2014, we diversified and we came into the infrastructure sector. We are right now one of the major manufacturers of modular steel bridges, the Bailey Bridge, what we call for in India, catering to one of the major defense organizations and also to different state governments and catering to the export market. So we are one of the major manufacturers of Bailey Bridge in India today. Other core areas of interest are basically the refineries and the steel plants.
So how big is your setup in terms of turnover?
We have basically an employment of around more than around 100 people.
Okay.
Okay. And the order booking for this financial year is around 50 crores.
Vamsi, could you tell us what you do?
I run a brand called Jet Set Clean. So Jet Set Clean is into the business of providing super fast on-demand laundry and dry cleaning services delivered to the doorstep. So through a simple platform that we've created on the web and mobile.
When did you start it and is only Delhi based?
We started off operations in March 2015 with just focusing on some parts of South Delhi, and currently we've expanded to all 4 cities of Delhi NCR. And we've serviced over 7,000, 8,000 clientele in the last month.
Okay, so good enough for a starting point. Okay, let me get Souvik in. So what are your major concerns? If you can list them one by one. Let's look at your problem number one that you want to tell the mentors.
Yes, the first happens to be not of the liquidity, but non-fund based credit lines. As I said that we are into participation of tenders for the Indian defense and the government procurement schedules. So we require a lot of bank guarantees, be it in form of earnest money deposits or performance bank guarantee deposits. Okay, the moment you succeed in a tender. But the limit that we get from the banks, that's for a period of time, that gets exhausted by the time new tenders comes in. And at times it comes across that you have a lot of requirements, your infrastructure suits you fine, but you cannot participate in such tenders because you don't have the credit bank guarantees, non-fund based guarantees in place. So that is the point number one.
Okay, Ajit, you want to start with that?
Sure. So, I can appreciate that bank guarantees are actually a fundamental raw material of your business because of the way you operate, right?
Yes.
It's a very interesting way of looking at it. So, this can primarily be solved, if at all, by one of two ways. One is that since you exhaust your bank guarantee limits, if you had certain assets, which the easiest one of them might be your own equity into your own company, probably you could extend by a certain multiple, maybe 2 to 3 times the amount of bank guarantee that you will be eligible for. This would work only if there was a certain attributable value to your equity. So there are various ways to do it, to get a valuation, get an equity investor in, consider listing, etc. But that could significantly enhance the amount of perceived collateral that you have. Right? The second one is that for individual projects, since you're at a 50 crore turnover, each one of the projects is likely to be substantial in size, such as a few crores. So what you could consider doing, assuming the terms of the tender allow a consortium or a group approach, is to get the financial guarantees from yet another party who has the muscle at that point of time and maybe an interest to get into this particular thing, and that would allow you to have access to other people's equity or financial line.
Okay.
Kewal?
I think in such cases, my advice would be to partner with a private bank. Make them a project partner in terms of financing that project, supporting the project, and also asking them to guarantee the project.
Okay.
Now, these types of partnerships work very well.
Okay.
And if you are a good ethical business and you pay back all on time, you do a good job and get your money and then exhaust the bank guarantees on time, then I think you will have a good partnership with any private bank who would like to work with you. then there is no question of the limits.
Okay.
They will support you. Quick, what
Now
will
you have to come out with various resources. I fully appreciate and agree with the suggestions what Ajeet has said that. And what is the other way to raise collaterals? Okay, there is a limitation for raising collateral.
Obviously.
The only way that is left with you is the equity collaterals. Now you have to start leveraging your equity. Either you go for private equity or angel funds or a strong partner who can take some stake in your company on project to project basis. That is one thing. Another thing is that of course you can think of, we have started very a great platform in terms of BSE SME. Okay, whereby you can think of getting your company listed so that in future you can use this equity like collateral to start expanding your business, because equity will become a big collateral, a currency in your hand, whereby not only you can dilute, because stock exchange gives the credentials and liquidity to your equity. So you can either sell your equity further in the as your company starts growing, start raising funds through equity also, or you can place the equity as a collateral and use it to raise funds.
Okay, let me get one in. What is your problem that you want to tell
So
the mentors?
the main challenge that we face is actually cash flow. Cash flow, when I say two reasons for that. One being that we work with a mix of both B2C and B2B clientele. With the B2C clientele, at least, it's guaranteed money in the next 1 or 2 days. But when it comes to B2B clientele, which as of now we have around 50%, almost 40-45% of our overall business is B2B clientele, right? And these are clients such as Oberoi Flight Services and multiple hotels and hospitals, for which also we take care of their laundry and linen business. The problem is here we have a rolling credit period of over a month and a half, and we are not a funded company as such, and we are a bootstrap company, which kind of limits our overall ability to work around cash flow.
So how do we
I'm
address this
going
problem?
to have to ask you 2-3 questions, because I'm quite familiar with your space. You're a new economy player doing an old economy business of laundry. First, what is the kind of discount you offer to a B2B customer compared to a B2C?
So that depends on the volume, and it goes as high as 50-60%.
Second question, on a unit economics level, do you still make money at present on the B2B business, or are you losing money on your orders?
We are making more money on the B2B business than the B2C, even after the discounting.
Okay, cool. So not in volume terms, in percentage terms.
Percentage terms.
Cool. So here are 3 thoughts that I have. Thought number 1, lot of businesses understand the value of cash discounts. Since you seem to be pretty cash rich in terms of unit economics, maybe if you offered your B2B businesses a cash discount, that pay me upfront or right away, etc., and I will give you so much discount, a lot of them will find that you might be a much better option than the treasury management options that they are doing, and I have seen this being quite prevalent.
Is it? Okay.
Yeah, it's quite prevalent in all industries. Right?
So I'm a little confused, because we've tried this already aspect, but the problem is most of them already have a set guidelines internally for vendor
I
payments.
agree. So 30, 60, 90 day kind of payment period.
Yes.
But there might be opportunities. If you've explored them, then we look at the second option. The second option is that since you look at the gap between what you have and what you're going to get, it is really a bridge/working capital requirement. There are many organizations who are willing to give that to you. Also, in terms of percentage, it might be significant, but in terms of rupees, I know that it runs into at this point a couple of lakh rupees.
Okay.
Right? Isn't that correct? The requirement is only a couple of lakh rupees. Even a very minor dilution of 5%, 7% of your equity would get you, runway for the working capital for as much as 18 to 24 months. Because even if you raise, let's say, 25-30 lakh rupees, that is the amount that you need to keep in the churn for you to be able to recover this.
True.
And finally, the other advice that I would have is not just in cash flow but non-recoverable. I have found many organizations such as yours who actually perish simply because of account receivables. Not because of delays, but because of unreceived account receivables. You understand what I'm saying?
That's something that hits a big way.
Correct. So what I want you to do is do not grow at any cost. Okay, because that becomes a recipe for disaster.
True. Most of these startups have the similar problem of liquidity. Either they expand too fast, or they invest their own capital, which gets stuck on recovery. Now, liquidity is very important. Your business may be profitable, but if you are not liquid, you may have to close down. And this liquidity sometimes goes, just to pay salaries, everyday expenses. If that's your case, then I think you need funding.
True.
You cannot do without funding. Banks will not give you working capital because there are no collateral you have in your business much.
I'm going to come in again if you don't mind.
Sure.
Extending this before Ajay speaks. SIDBI has a scheme called the CGTMSE scheme where they are going to give up to a 1 crore rupees line of credit at a very low interest rate of in the vicinity of 12.5%, which they deploy through public sector banks, and it is collateral free. Okay, so please explore that opportunity. It has certain requirements, such as the fact that a certain type of investor should already be inside, but it becomes a godsend for an organization such as yours.
I totally
Ajay, want to add to that? So two aspects. One, right type of clients from where you are getting payment on right time. Maybe you can go for a small number of clients, but which are credible clients, which are giving you money on time. And also explore the various finance availability that is available in the system. CGT SME scheme is one of it. Now it has increased to 2 crore. Let me tell you, from 1 crore, it has gone up to 2 crore under CGT SME scheme. Okay, few of the banks have started. You can look into that. I think 2 crore is much more than what you require at this point of time. You may think of 2 to 5% of dilution in your company, whereby you can bring right type of investors who had already prior experience in this type of business.
So, what are the second problems?
The second problem comes in the field of research, innovation and development. When the moment you start innovating a product, you have to give them a backup of the engineering. And the moment you want to have an engineering backup, it needs to be certified by one of any premier institutes around, in India. Let's say we approach any of the big institutes in India, the government institutes, and the colleges. So it's basically, you need to pay up upfront, and that is in crores. An SME who has the idea of innovation and can put into use just gets stuck up just because of he needs to pay in crores to get the design vetted by some of the best institutes in India. So this is something that really bothers us.
So very genuine problem. So what's the way forward? Kewal,
may I just inform you, it's very interesting you're saying this, because I used to head the business incubator at IIT Bombay. Right, so I must tell you, when you say that you need to pay an upfront fee, this is in the form of a consulting fee. So the oldest IITs in the country are very large. There are many departments. So for instance, if you went to their consulting wing and said, this is what I want to do, they might say, give me 1 crore, give me 5 crore, whatever is the amount. However, if you went to their technology business incubator, it might be an entirely different thing. So that could be one of the approaches you could take, where you could get one of the professors, research scholars or other such person on board onto the research project, and you could together develop this, commercialize this, and share the benefits of the commercialization with the institute. I know how we did that at IIT Bombay. Structuring it is not easy, but it's been done dozens of times. Different IITs do it in a different ways, but it can be done. Having said that, I don't want to belittle the fact that this is a fairly complex thing to do. Right? And at least establishing the initial relationship can take a substantial amount of time.
Innovation is very critical to your business. And if it will define your future, then you have to invest in innovation. As simple as that. Now you have to find ways to invest in innovation. You may dilute your equity, get some more money, and that money you can put in investments. Or you can define that in a year, I will put 10% of my turnover on investment, deploy back on investment. This is a very conscious decision an organization has to take. Right now you are looking at innovation as an expenditure. I want you to look at innovation as an investment.
I want to add here, see, most of if you have got 15 to 18% of profit margin, from all standards in companies like manufacturing company, I feel that it's a good margin. Let me tell you.
Particularly in engineering, it's very good.
That's why in the engineering and manufacturing, it's a very good profit margin. That's number one. Number two, see, today you have got 50 crores of turnover. Now if you think that, and you are saying that money is a constraint, now you have to think that whether you have to innovate and do the research or have a research and technology wing inside your company, or you want to make someone your technology partner and start procuring from there, which is very cost effective. If it is so, then better tie up with someone who can provide you the right kind of technology, and you start using it till the time you reach a threshold. Okay, say for example, if you start moving from 50 crore to 200 crore, and there you have got sufficient fund which you can deploy in research, and from there your growth is unlimited, then start doing that. See, all these things, ultimately in each and every business, money is a constraint, whether it's a startup or whether it's a small cap, whether it's mid cap, unless until the company has gone to a huge turnover turnover with very high profit margin, then they start, you know, putting a lot of money towards research and all these activity. But at this juncture, you have to think that whether I should put sufficient funds toward this activity or try to have a technology partner, or Ajeet has rightly said that you can have some expert from this IT or Bombay or Kharagpur wing, whom you can bring it, get it commercialized or have some profit sharing basis.
Let me get Vamsin. What is your second problem?
So my second problem also stems from the first, which is again a cash flow issue. So I'm hoping Kewal and Ajit can help me in this. So when we're just talking about scaling up, I completely believe with your logic that scaling up slowly is rather required than spending all your money on marketing, which I've seen most other players have done. The problem is that has spoiled the customer, and they're so used to that discounting system, which we have very specifically avoided to B2C customers, and we are very keen to grow at a slower rate without burning too much, and we are currently looking at breaking even in the next 4 to 5 months. The problem is, if I now approach, which I've been doing anyway, angel investors for the last 1 odd year, they want us to scale up at a much faster rate so that their angel investment gives them a higher return. But if I do that, I see a faster rate of failure, at least in my own head, and this is where the biggest challenge for me is to convince an angel investor or any investor, even if it's a small fund, that his rate of return will be something that he expects, because we do not want to grow at too fast a rate that will kind of damage the brand in the business, because we've seen a lot of brands, especially in our industry, falling down because of that. They've lost complete customer sentiment, and that has literally put them down.
Very interesting. You know, there are a whole lot of platforms today available, particularly in the food industry, where you go to them, they deliver the food at the doorsteps. Their rush time is the evening time, dinner time, or the afternoon time. Rest they are free. If you tie with them to go to your customers to pick up your clothes for you, you go asset light.
Okay.
And you scale up your business without investments. Think about it. B2B is always a risky business. They always ask for discounts, and your money will get blocked. Here the money never gets blocked.
True.
It's a cash every day for you.
It's a cash there.
Think about it, and you will find a solution to your business.
What I would recommend is that your first round of funding, if you remember, Ajay and I told you a small dilution. I talked of maybe 5-10%. He said even to 3 to 5%, probably is best done through somebody who is an expert in this field. These people are called strategic investors. So for instance, you don't wash your own clothes. I'm sure you get it done from somebody, right? Now this person probably is not tech savvy enough to be a laundry on the cloud. That person presents a very interesting investor at this stage, right? That could be one option. The second thing could be somebody who has been in this entire supply chain, not necessarily as a laundry supplier, it could be a detergent supplier, laundry equipment supplier, etc., who sees this as an adjacent business. I think that this sort of an investor's attitude would be very different than an angel investor's attitude. And having been an angel investor now for 18 years, I know that if you came to me and said, I don't want to grow very fast, anything you say after that I don't want to hear.
Yes, I agree with you. I've said that, I've done that mistake 2-3 times.
Yeah, so I think that looking for a strategic investor to get through your initial bottleneck of growth is probably the only way around for you.
Okay, Kewal, parting advice to both these entrepreneurs.
For you is innovation. If that's your business line, then you need to think, how do you need to raise fund or capital for innovation? I think it's very, very critical for your business. For you, I think growth is important. At the same time, you have to be above water all the time. So for growth, think of different ways of growing. And be on asset light on growth. And on liquidity, maybe you need to raise your funds to make it yourself more liquid.
Ajit?
Sure, with 15 plus years of doing what you're doing and having reached this level, I think you're doing a lot of things right. Having said that, I think that you now are at the next level of growth where what you have been doing is slowing down your progress. Exactly. So some rethink has to be required either on the research part or on the partnership / equity / ownership part.
Okay.
Vamsi, on your end, however, and I deal with a lot of entrepreneurs at your end of the spectrum, I must say that if you were to take my advice, I'm not going to tell you how to wash your clothes better, and that's probably not your question either. I think that very quick and substantial results will come out of better financial engineering of your corporation.
Okay.
About how money flows, who owns what. So financial engineering is, I think, your challenge, and based on the questions you're asking, I think some more thought has to go into that.
Ajay, last word for you.
I think for you, already you start leveraging equity. Okay, come on the SME platform, have some strategic equity partner also, and think of having a technology partner rather than at this juncture investing, because you require a lot of money for your business planning and all this. So I think debt fund is not suiting at this juncture. Okay, so really. Of course, so you have to leverage equity. And of course take the help in the technology, as we have discussed rightly. So that is the one way, and I think you sought to take your business to the next level for you. You have to do both business planning and financial planning. Okay, and never have this thing in mind that because somebody has failed, so you may, because past success will not guarantee future success, and past failure will not guarantee future failure. Okay, and never talk to anyone about not increase in the business. You will have an increase in the business, but you say that I will have a modest increase, or I will see the future business and then accordingly I will grow. So that will be the right approach to take your business forward.
Maybe you add the word profitable growth.
Yeah, now that we've come to that.
Okay. Shomik, Vamsi, I hope some of your concerns have been addressed.
Very much.
Very
much. Thank you, sir.
Thanks, Ajeet. Thanks, Ajay. Thanks, Kewal, for being on the show. Thank you very much.
Thank you so much.
Focus, ideate, innovate, enable.